Hello everyone, this is Kathy Lien with BK Forex. Good morning, or good evening, your time. It's morning time, my time. I want to thank all of you for joining me for this fun discussion on 10 trading tips for trading Forex. Now, this discussion is definitely going to hit on a lot of specifics and not just things that I think but hopefully some things that you will find insightful as well. But before I begin, I'd like to show you this disclaimer that says trading Forex carries a high level of risk and may not be suitable for all investors. So for those of you that are kind of watching this as a recording, I highly encourage you to pause the screen, read through the disclaimer thoroughly before moving forward. And I also want to thank Pepperstone for inviting me to share my thoughts with you today. Now, trading Forex can be easy, in my opinion, with some of these tips in your pocket. And these tips, I think, will hopefully give you, kind of insight into a different way to look at the Forex market, or at least the way that I look at the Forex market. The tips that we are going to cover today in this session center around these ideas. We're going to talk about some of the most important Forex market correlations, especially the ones that are having a pretty pressing impact on currencies these days. We're going to talk about when to trade and when not to trade Forex, some of where the best opportunities are, when you should kind of avoid looking at trading opportunities because you could possibly sabotage the trades. We'll go over some of those different scenarios. We'll also talk about some of the best chart setups for picking tops and bottoms, in my opinion. And, some of them are very tempting these days because we do have a lot of aggressive moves in currencies that, could potentially attract a lot of bottom pickers. We'll talk about how to design strategies like a hedge fund manager and, kind of the way they think about trading. And then we'll talk about some of the mistakes to avoid in the market. Okay, so starting off, I want to start talking about something that is kind of impacting the market right now. And if you're trading Forex, it's absolutely important for you to stay on top of this. And it's basically the correlations that are driving FX flows and learning how to use them to your advantage. Because every single day when I wake up, I always look at some of these correlations in order to gauge where I think currencies are and what the potential opportunities could be. So the first tip that I want to share with you is the most pressing one. As you all know, the markets these days are being rocked by the scenario or the situation in Turkey. Turkey's currency fell like 40%, well, maybe not 40, maybe 35% year to date. And that's caused a lot of anxiety, not only in Turkey, but also the entire Eurozone. And it's having a very significant impact, not only on the euro, but on all of the major currencies. This morning, the euro is at a fresh, it should be 14th month low, I believe. It's at a fresh low since June 2017. So yes, it's at a fresh 14th month low. And it's at a fresh 14-month low for one reason and one reason alone, which is that the situation in Turkey is getting more and more serious. This morning, Turkey announced new sanctions and they refused to release the U.S. pastor. Turkey's got a whole bunch of different things that are impacting the currency. On the one hand, it's got a lot of huge amounts of current account deficit. The weakness of the US dollar is driving up the cost of debt servicing for the country, but also they're mired in a political fight with the US, which certainly isn't looking well for them. And so investors, there's been a complete loss of confidence by investors, and they're looking at this like it's just going to get worse. And the reason why Europe is so exposed is because the Eurozone has a lot of banks that hold Turkish debt. Now, even if those banks aren't going to blow up as a result of the exposure to Turkish debt, the fear is that it's going to lead to some sort of banking crisis in the Eurozone, or maybe even a significant loss of confidence amongst businesses and consumers and investors in the Eurozone. And that's what could snowball into a significant move. So what you are looking at right now is a chart of the Turkish lira, which is the candle, and the faint blue line is the euro dollar. And the euro dollar is inverted because it's dollar euro versus dollar lira, so they're on the same page. So you can see that this is an intraday chart, but you can also see the correlation, and I want to show you if I can pull up this correlation here on my Bloomberg screen. And the chart back here is from tradingview.com, which is kind of broker neutral, and they do a good job of allowing us to compare different asset classes. Today we have some sort of specific drivers that's causing the lira to fall because of the fact that the government announced a short squeeze ban. But if you take a look at the dollar euro, or at least the sanctions, you can see, I don't know if I can get it onto the same screen. If not, I think the axes are kind of different. But you can see there's a tight correlation, in a long-term perspective, and you can see the correlation even stronger on a short-term basis. So how can we use this information to our advantage? Well, you absolutely have to be watching. If you're trading the euro, you have to absolutely be watching the Turkish lira. Now, the Turkish lira is up today, but it's not up for the right reasons. It's not up because Erdogan announced some, sweeping measures that's going to transform their economic outlook and the current account deficit. It's only because there's been a short squeeze because of the measures that they announced. So investors are not buying euros as a result of that. They continue to punish the euro, and they've driven it to where it is right now. And so if the Turkish lira resumes its slide and heads to 7, and you can see that right now we're trading at at a different value from there. But if it does trade, it's at 6.17. If it does trade to 7, then you're going to see the euro at 110. So this is a very important correlation to pay attention to. And whenever we have these exogenous risks, what's driving the market will be a chart that you follow. So the tip I have for you with the Turkish lira is, follow it. A lot of news agencies are talking about it. If we do get a final bottom in the lira, for whatever reason, may it be the government's efforts or they actually decide to release the American pastor, then the euro would be a buy. But until that whole situation pacifies, there's actually a risk of the ECB maybe saying something that could raise some concerns in regards to the exposure of European banks to Turkish assets. Otherwise, it'll be very difficult for the euro to find a bottom. The second tip that I have for you this morning is also one that is very timely, and that's the relationship between dollar yen along with the dollar renminbi and the yield spread. So we'll start off with dollar yen and the dollar renminbi. Today, this is a chart I drew earlier this week, but today you can see that the dollar renminbi is basically continuing to rise, and this correlation, which shows the dollar yen as the orange line and dollar renminbi as the white line, shows you that over the past year, and even for a longer period of time than that, there was a very strong correlation between how dollar yen was moving and also how the renminbi was moving. And that correlation kind of diverged this month, but today dollar yen is back up, and you can see that the correlation is resuming once again, where we do see dollar yen moving back up in relationship to dollar renminbi. So how could you have used this as an arbitrage opportunity? Well, dollar yen, which had fallen up until Monday, if you were watching the dollar renminbi, you can see the dollar renminbi was actually moving upwards. That it suggested to me, and should have suggested to you, that that the slide in dollar yen would be limited. However, every single morning when I turn on my trading screens, the most important correlation that I look for, I look at every single day, is the yield spreads, because sometimes these moves in dollar lira, dollar renminbi, they don't change all that much, unless there was some sort of breaking news overnight. It really doesn't change that significantly, whereas the yield spreads can change quite rapidly. So given that the yield spread could change quite rapidly, it's very, very important to look at yields. So you can easily take a look at what yields are. If you just went to, I use my Bloomberg screen, but if you just went to TradingView, they've got a yield spread monitor. Scroll down here, go to markets. And go to bonds. And I'll load in just a second. So it's going to come up over here in this box here. Sorry, I don't know why it keeps on reminding me to not allow. So you can see that this morning, 10-year Treasury yields are actually down. And let me just confirm that with my Bloomberg. So 10-year Treasury yields are down, and down a lot, 2 basis points, actually quite a bit of a move. So they're down, 2 basis points. And so this tells me, and you can see that JGB yields are also down. But typically in the U.S. session, JGB yields are already closed. So typically in U.S. session, all the market really focuses on, or during the day, the market really focuses on is what is happening in 10-year yields. So this morning for me, or this evening for you, 10-year yields in U.S. are down a lot. So that suggests to me that the rally that we saw in dollar yen over the past few days could actually hit a brick wall. and that we may actually see some resistance. And what's interesting is that if you look at my dollar yen chart with me, and please ignore all my squiggly lines. Let me get rid of the Bollinger Band so it's a little easier for you to see. If you look at this dollar yen chart with me, you can see that the decline in yields coincides with the pair's rejection of the 20 SMA on the daily chart, and also the rejection of the 200 SMA on the 4-hour chart. So this suggests to me between, if I was laying on a trade this morning, between the decline in 10-year yields and the technical rejection of key moving averages, suggests to me that today we could actually see a drop in dollar yen rather than a rally over the next few hours, and that dollar yen perhaps could go all the way down to 110.80 during the New York session. And the driver for that would not only be the move in yields, but you can see across the board currencies are down, that the risk aversion may have finally hit dollar yen. And the reason I have confidence in that is because this relationship I'm showing you only from the beginning of the year, but the dollar yen and the US Japanese yield spread relationship basically has stood the test of time, and you can go back years and years and use this as a basis for formulating where you think that these pairs could go from a macro perspective. Because even though I use it to put on my day trades, it's a really important guide on a macro perspective too, because it would be very difficult for dollar yen to rally if the orange line in this chart, the yield spread, is falling. And I'll show you how this is the case for some of the other pairs too. Now, most of you may be focused on trading the Australian dollar, because that's the local currency for a lot of our Pepperstone customers. And so there's some tips that you can also use to help you hopefully find more high probability Australian dollar trades. So there are primarily 3 important drivers for the Australian dollar. First and foremost is, once again, the yield spread. The orange line here is the Aussie dollar, the white line is the yield spread. And it will be very difficult for Aussie to rally if the yield spread is also falling. And you can see that brief periods of divergence, and I don't even really see a divergence on this chart, but brief periods of divergence, maybe on the left-hand side in December, where Aussie rallied but the yield spread declined, typically do not last for long, as the markets kind of realizes that yields reflect the true sentiment in the Aussie dollar. So you can see here that the Aussie dollar is the orange line and it's falling, and the yield spread continues to fall, which on this day, which was, I think, Monday, suggested that Aussie dollar could continue to fall. So many of you may be wondering, okay, what does this show for today? So if I pull up the Aussie dollar chart, you can see that the white line is the yield spread and the orange line is the Aussie dollar. And what's interesting, first of all, just a quick look at this chart, you can see there's a very strong correlation. If we zoom in, Aussie's obviously hit a new low, but look at this, the yield spread's stabilizing. And given that the yield spread's stabilizing, maybe it tells me that the Aussie could bottom. So rather than just arbitrarily picking a bottom, I may go to my chart and I'll look to see, is there any significant technical levels? Yes, there's a significant technical level right at these areas here, which is 7160. So 7160 is not that far from here. So perhaps, in my opinion, maybe a high probability trade if we fuse the idea of the yield spread stabilizing and Aussie dollar meeting significant support is perhaps buying here with the stop right, maybe 7150, because it's not that far away from where we are right now. So it could be a low risk turn trade for a move back up to 73 cents. I mean, I'm not giving you trade ideas. I'm just sharing with you how I would process some of these ideas and tips to help you think about whether it's time to pick a bottom or whether it's time to look for stabilization. Another factor that has a very strong correlation with the Aussie dollar, and another driver of the Aussie dollar, is commodities. And gold is very important for the Australian dollar. You can see the blue line is gold. The bars are the Aussie dollars. So gold prices are falling. Aussie dollar is falling. This is a weekly chart. So it's not as reliable. It's more of a the yield spread is more of a lagging indicator in some ways, but today gold is falling again. So that is supportive of more of a drop than a rally in the Australian dollar. And the last piece of the puzzle is the Australian dollar and the Chinese yuan. And the Australian dollar Chinese yuan effect is more of a macro effect. We need a long-term turn in the Chinese yuan before we get a long-term turn in the Australian dollar. And the Chinese yuan is actually inverted here. So the faint line is the Chinese yuan. So the falling, that's falling suggests the Chinese yuan is falling, and the bars are the Australian dollar. So we want the Chinese yuan to stop falling in order for the Australian dollar to stop falling, but we need a real bottom, not just a short-term blip. And I don't think we have that right now. But nonetheless, the yield spread is starting to flash the first sign to me of a potential bottom in the Australian dollar. My fourth tip is for those of you that are trading the New Zealand dollar. So what moves the New Zealand dollar? Of course, it's a whole bunch of things. Macro factors like how the economy is doing, what they're feeling in terms of what they're feeling in terms of where they want to take interest rates, more up, data like dairy prices or whatever pieces of economic reports are coming out. But in my opinion, I think that one of the most important correlations for Kiwi, which doesn't always work because sometimes Australia and New Zealand have different things going on, but one of the things that does have a very strong impact on the New Zealand dollar is, of course, how the Aussie dollar is trading. Like yesterday, for those of you that were trading yesterday, the Australian dollar was selling off, the New Zealand dollar was rallying, but that move did not last for long. And it did not last for long because at the end of the day, what really mattered to the market was this correlation. And it's very difficult for Kiwi to, unless the RBA is a result of something the Reserve Banks said or did that is completely different from what, I don't know why this is showing this PowerPoint thing is, let me just shut this down. So unless there's something driven by the central bank, the correlations will resume. And that's why Kiwi, at the end of the day yesterday, ended up moving to new lows as well, even though it had started my day, ended your day in positive territory. So that's quite important, I think, because that will give you a gauge of whether or not a Kiwi move can last or whether or not it's going to have continuation. The fifth tip is how to trade the Canadian dollar. I love trading the Canadian dollar, especially on a short-term basis, because I feel like it reacts very, very well on a short-term basis. And the thing that I like to look at the most is the yield spread again. And once again, it's very difficult, in my opinion, for dollar CAD. You see this relationship all the way to the beginning of the year. It's very difficult for dollar CAD, the white line, to rally if the yield spread's falling. And that's why dollar CAD had a fake rally on yesterday, because yield spreads continue to press lower and eventually tugged dollar CAD down. Now, you may be interested to see, and you may ask, how's the yield spread doing today? And once again, the white line is dollar CAD, the orange line is the yield spread. Yield spreads are continuing to press lower, and they're continuing to drop to new lows. So it'd be very difficult for dollar CAD to sustain this move higher if the yield spreads continue to fall. And that's pretty consistent with the Bank of Canada's positive view. The market actually thinks the Bank of Canada is going to raise interest rates at the end of the year, and the fact that U.S. yields are falling. The other correlation that's important is oil. So you can see as the daily chart, the faint line is oil prices, the bars are dollar CAD. So very strong correlation. If oil prices are falling, dollar CAD's falling as well. So the only reason why dollar CAD's staying propped today is because oil is down 1%. So when we have a divergence in the yield spread and oil, like say oil is falling, the yield spread saying that dollar CAD should rise, and the yield spread is dropping, saying dollar CAD could fall, I'd probably avoid trading dollar CAD. But if we have a scenario where oil prices are up and the yield spread is pointing to Canadian dollar strength, then that sends me a very strong signal to sell dollar CAD. So that's something that you could also look at quite easily and follow using some of the public charts that are available. So those are the first set of tips centering around currency correlations that I like to look at, and I think would be interesting for you to follow. The next set of tips focus on when to trade and when not to trade. We'll start with when not to trade. So whenever I put on swing trades or day trades, these are the times where I try to avoid trading. And it's basically before a major rate decision, because as attractive as a setup may look, it can easily be sabotaged by something the central banker says or a sudden decision that they may have. And I think this is quite important because oftentimes you may get a very tightly wound consolidation. You may think to yourself, particularly maybe at a bottom, and you may think to yourself, wow, this pair has been forming, has been consolidating and maybe forming a bottom because it hasn't moved at all. But then again, maybe it hasn't moved because the market has no idea what the central bank will say or do. And so they're just kind of waiting it out to see what will happen after the central bank makes its decision. So I never trade before a big rate decision, even if I have a strong opinion, because the reactive trade, the trade that opportunity that you get after the rate decision is done, usually is much more lucrative than much easier to identify than the trade before a major rate decision. I also don't trade before a major speech or a political announcement. So if we know that Prime Minister May is going to make a big Brexit speech, then I'll probably avoid trading. The British pound. Same story. If I know that the RBA governor is going to make a big speech, I may avoid trading Aussie dollar. That's just a way to think about. How to position yourself for the best opportunities by avoiding the worst. And I also don't trade immediately after breaking news. Usually I like to wait for the dust to settle. And breaking news is like, certainly maybe a big political announcement. But it really depends. That's a soft rule, not a hard rule. Because sometimes the breaking news can have a great deal of continuation. The only danger out of that is that your risk reward may be difficult. And then lastly, I don't chase the Sunday gap because gaps are usually closed, and I'll share with you an idea on how that's done. And so chasing the Sunday gap is often the wrong trade. So when do I trade? Well, I trade every single day pretty much, and these are the opportunities that I see for trading in your time frame. And these are the ideas that I use. So basically on Monday, when you start your trading day, which is Sunday evening my time, if there's a gap, I'll look to fade it. if there's a continuation, if there's no gap and the trend just kind of continues softly, then I'll follow the trend. And that oftentimes it's a great time to put on swing trades because the market's closed, opening from a closed basis, and then it's giving those new traders an opportunity to continue to press a previous view that they may have. Monday night your time, which is right now, morning my time, Mondays are notorious for reversals, in my opinion. And I think that Mondays are a great opportunity to fade the moves that we've had before. So if we look at, for example, Monday, we just go to the 5-minute chart on Monday. If you're trading like to trade at night, what you'll see is that there was a huge run up in the first part of the New York session, but only to be followed by a sharp reversal. So if you're up this late, fading, you can expect to look for reversals during the session. But if you're trading earlier in your evening during the European session, then continuation of the Asia move tends to be a bit more likely. In your mornings, every single day, which is my evenings, I like to look for swing trade continuation opportunities. And then on your Friday night, which is my Friday morning, Fridays, so Mondays are notorious for fades. Fridays are notorious for big breakout moves. So oftentimes, sometimes some significant levels are broken before the weekend. And so continuation in anticipation of breakout trades can be quite interesting on your Friday evening, my Friday morning. So one of the ideas that I shared was trading the Sunday gap. And we had a gap, and the reason why I'm showing you this because we had a gap this Sunday. And I think, you know, it's really important to keep some of these ideas in mind because while it may be very tempting to jump into trading the gap, the vast majority of weekend gaps are filled. And in my opinion, it's much more fruitful to fade the weekend gap. And gaps are usually filled quite quickly in the hours that follow. It's much more fruitful, in my opinion, to fade the weekend gap than to try to force yourself to follow the gap because gaps generally closed 80% of the time. But you do need to give yourself plenty of room to trade this gap. And let me show you exactly what I'm talking about. But if you do trade the gap, you also need a time stop because that's obviously very important. And if the gap is not filled by the late European session, then it's a runaway gap and you need to cover. So the reason why I brought this up is because let me remove all my lines. We did have a gap this Sunday right here. And, you know, when the gap occurred, it was really tempting to sell into it because, you know, this was all based on the thesis that the situation in Turkey was going to worsen. And, you know, eventually did because, you know, eventually we're now trading in the low 113s. But if you traded this and you sold at the open and you sold around 113.85, look what happened. It just reversed in your face because this entire gap in the euro dollar was filled. And this is very, very characteristic of weekend gaps, which is that, you know, almost the majority of the time when you see these gaps, and of course gaps don't happen all the time, but when you see these gaps, it's much better to fade it than to follow it because 80% of the time the gaps are filled. Okay, so the next tip that I want to share with you is how to identify the best fundamentally driven trades. And that kind of centers around the idea of when to trade. And how I talked about in your morning time when you wake up, which is my evening time, it's a great period to look for swing trades, fundamentally driven swing trades. And the best way to look at it is to take a look at it from a big picture perspective. You want to identify the story that was happening during the New York session. Read about my daily report. You can follow me on Twitter, where I post the link to my daily report, where I talk about the big story that happens during the New York session. I also talk about the currencies that are most affected. And then once you've kind of honed in on the story, you want to look for the strongest, weakest pairing at the New York close to look for opportunities into the Asia session and the European trading session. And you want to see if there's economic data that can affect your trade, because through everything that we're talking about, data has a very, very big impact on how you can trade, because data can be tradable. And so while we're looking at it from a big picture perspective, there's also opportunities to trade Australian data, for example. And I'll talk about exactly how. So there's two types of information. One is scheduled data, and data that's on the calendar that that's going to come out. And the best resources for scheduled data are some of the public calendars that are available out there, which already outline the economic news releases, when central bank meetings are, when we have G7 meetings, when there's an OPEC meeting and things like that. So that is happening. And when that's happening, you can schedule your time to either trade it or not to trade it. Because, for example, I don't trade rate decisions, but I love to trade after rate decisions. And then there's unscheduled data, which is breaking comments from central bankers, option expirations, upgrades and downgrades from rating agencies, a sudden tweet from President Trump. So those things are the unscheduled releases that could also have a significant impact on a currency. So, the best places for scheduled data is the public calendars, like Forex Factory. The best unscheduled resources for public data is Twitter. And I like to follow Forex Live, Zero Hedge, Rand, Squawk, and Reuters. So that's where you can keep on top of information. But in terms of tactics, the best way, in my opinion, to trade Australian data is to fade it. And the reason, and I'll talk about the reason why, but the reason centers around the fact that there tends to be lower liquidity in the Asian trading session. So a lot of the move happens very quickly and then doesn't have any continuation. So let me give you some examples. So we have the trade balance here. So the trade balance number from Australia, it was just this month's release, and you can see came out very, very strong. So blowout number, double expectations, 1.8 billion versus 900 million forecast. So you would think, okay, this is extremely, extremely positive for the Australian dollar. So let me buy. And yes, if you look very closely, you do have a spike in the Aussie dollar off of the release, but then it just craps out and there's zero continuation. Here's another example, very, very important report. And the reason why I'm showing you this example is because tonight we also have the Australian labor market data. So we have the Australian labor market data. The number comes out exceptionally strong, 51,000, 4 times greater than forecast. Can't really get better than that, particularly since all the job growth is full-time jobs and the participation rate improved. Really, you cannot get better than this. So you think, really hot number, I should buy Aussie. And yes, all of the move, it's a big move, but all of the move happens immediately afterwards. And so instead of buying into the move, the much more fruitful trade, regardless of how fabulous this number was to fade it. So I'm showing you this example because we have Australian employment tonight. And you may be thinking, how do I trade Australian employment? Well, there's 2 ways to look at this and 2 ways to potentially trade. The first way is just to fade it outright, assuming, and this is a 5-minute candle. You certainly want the 5-minute candle to close first before getting into the trade. So the first move is you can just wait for the 5 minutes candle to close and you can just fade it with a stop at the news candle high. So the news candle high here is 74.43. So if you sold it after the first 5 minute candle closed, it would have been around 74.30, and with a stop of 74.45, not a very wide stop, for a potentially good trading opportunity. The other way to trade it is if you really want to follow it, then I would put a buy order above the new candle high, making sure that it breaks the news candle before riding the continuation move. So you may be wondering, why is fading better, especially since, especially in an environment where the data could be is so good. I mean, that Australian employment number was fabulous, and the reason is because the market during the Australian session is really controlled by just 4 banks: ANZ, Commonwealth, NAB, and Westpac. And the majority of the activity is there. And in dealer markets, when the dealers are kind of in control and they don't have to fight against other major banks like European banks, US banks who are in the market, breakouts tend to be faded because they're mean reversion traders. So they like to fade breakouts rather than follow it. Are there exceptions to the rule? Of course, there's always exceptions to the rule, but more, and that could be if we have a huge RBA rate decision, or sometimes if the data reinforces the existing trends in the market. So if the market is really bearish Aussies and you get a really weak Australian employment number, sometimes that could be just the excuse they're waiting to break a key level. So there are exceptions to rules, but more often than not, Australian data can be faded. So the 9th tip I have for you is the best chart setups for picking tops and bottoms. And these are just some of my favorites. I mean, of course, there's tons and tons of different chart setups out there. But I feel like if you're looking for candlestick patterns, these are my favorite patterns to look for. And when I see them, usually they're a pretty strong signal for a top or bottom. So the first one is a shooting star. Shooting star is where you have a really large body and a small candle towards the bottom of the range, and it doesn't matter whether it's green or red, black or white. The fact that it closes near the range is very bearish, but it's even more bearish, obviously, if it closes red. So you see some shooting stars here, and shooting stars very often coincide with little peaks in the pair. You even have a shooting star to the left of this candle that I didn't even highlight. Let me see if I can pull up my drawing tool. Oh, I don't know if I can. It doesn't look like my drawing tool is working. But anyway, to the left of my first arrow, you'll even see a red shooting star. And it's very consistent with short and medium-term tops. Now, I only use these on daily charts, but I find shooting stars is a very effective way to pick a top. Same thing with dojis. Dojis are also very effective ways to pick a top, particularly when you have a series of dojis. And I love evening stars. Evening stars are actually some of my favorites, some of the best formations, because it's a combination of a pseudo doji-like formation where you have a candle with a very small body after a big move, followed by a sell-off, which confirms to you already that there's a sell-off. So there's a confirmation candle by the following candle, and that usually is consistent with a very sharp turn in a currency pair. So you can see in this example here, we had a rally. We have a small candle and then a sell-off, and then there's continuation. And then another one is bearish engulfing after a strong uptrend, also very consistent with a potential top. Picking bottoms, that may be what you guys are much more interested in these days because currencies have sold off aggressively, and it's very tempting to pick a bottom. Double bottoms are really good to look for, although double bottoms are harder to identify. But what you're looking for in a double bottom is you obviously want the initial bottom to be set up, like where I listed number 1. You want to retest the second bottom, and then you want to break the neckline. The reason why they're challenging to find because it's never so picture perfect. It's never so clean. Usually it's some sort of, jagged price action, maybe make a new lower bottom before it actually bottoms out. So it's a little bit more difficult to tell. Whereas it's a little bit more difficult to tell, whereas some of the other candlestick patterns may be a bit more easy to identify. So, hammers, on the other hand, are pretty easy to see in the charts. Hammers after a long downtrend usually is a good candle preceding a big move upwards. Also really like dojis, particularly after big moves. And you don't see dojis too often. Morning stars are very, very powerful patterns, just like evening stars in picking a bottom. But here's another example of a morning star right at the bottom of this. You have a little morning star on the left. And bullish engulfings after strong downtrends are also, very, very attractive. We obviously don't have any of that yet in this downtrend. We have a little bit of a morning star over here, but this consolidation candle isn't very strong, and the previous candle is a very small one. But even if you bought there, you would have at least one candle worth of continuation. This is a very strong bottom signal, and it accurately predicted a bottom for about 100 pips. Sometimes it predicts a bottom. This is an engulfing pattern, and if you bought this bottom, you would have gotten 150 pips. But right now, nothing yet. Nothing in the euro. Nothing in pounds yet. Dollar yen does have a pseudo morning star formation. So, I still think losses in dollar yen are limited. And of course, Aussie, nothing yet here in Aussie. But, it may not be a terrible bottom against this level here, especially as yield spreads kind of stabilize. So with all of this in mind, I've shared a lot of thoughts and ideas on trading and how to look for potential setups for picking tops and bottoms, how to fade data, how to fade the Sunday gap, how to look at correlations. But how do you really create a trading strategy out of this? And so I wanted to give you some insight because I used to work with a lot of hedge funds in how hedge funds like to think. It's because many of you are taking some of these ideas and some of you are just looking at the prediction of this. Some of you are thinking about how can I turn this or some of the other ideas I have into a trading strategy. And having worked with these funds, I feel like there's really 6 key steps that fund managers use to think about their trading strategies. And they boil down to defining a strategy, money management rules, testing it, understanding performance, understanding drawdown, looking for improvements. And but I want to drill down to each of these in a little bit more specific detail. So the steps to developing a successful trading strategies. First and foremost, you've got to figure out what you want to trade by trading it live. You want to dabble in the markets. It could be through a demo account. It could be through a mini, smaller size account. But you want to try it out in real market conditions. And you want to basically, try out a situation and see, because by trading live, you get a feel of the strategy, you get a feel of how you should be defining the initial trading rules. Because it gives you insight into, where should I put my stop, what type of entry I should be using. And so the first step to trading is having preset rules, defining the initial rules of, what kind of setup you're looking for, and what type of time frame you want to trade. For me, oftentimes is when I should not trade. And what pairs you want to be trading, because for example, when I day trade, I never day trade the pound crosses or Aussie Kiwi, because for me the pound crosses have too much volatility, and my stop, which is usually about 30 pips, is too tight for the pound crosses. And I never trade Aussie Kiwi because oftentimes it's a pair that has more likelihood of reversing than continuing, and I'm much more of a flow trader. So after you've defined the trading rules, you want to refine them visually on charts. And I could have a whole presentation on just this segment, how to think like a hedge fund manager, but I just wanted to give you the initial ideas. You want to refine it visually in the charts. Then you want to back test it, either back test it in Excel, or you code it or pay someone to code it in order to see how the strategy back tests. But you never want to just trust the machine results. You want to let the machine run, watch it trade, understand when it fails, refine it again, and then once you feel comfortable with it, that's when you can trade it live. And even after you've traded it live, it's important to assess your strategy every 6 months or so to get a sense of whether it's working or not working. So that's basically how you can use some of the techniques that fund managers use to develop their trading strategies, because they have a very well thought out process into developing your trading strategies. And then I want to leave you with 3 mistakes that all Forex traders make, and I think it's imperative for you to avoid, and that's the last tip that I have for you today. And these tips have been all over the place, but hopefully they've been valuable to you from different perspectives. And the first mistake is that the stops are too small. You can't use the same stop for every single currency pair. The general rule of thumb for day trading is the stop should be half the daily range. If it moves beyond half the daily range, and it's the average daily range, not just yesterday's daily range, because yesterday's daily range could have been very small, especially if the currency pair has been consolidating. But you want to use a stop that's at least half a daily range for day trading. Otherwise, if your stop's too small, you're going to get stopped out often. And for the euro dollar, it's approximately 50 pips. And the reason why is you want to avoid the churn of multiple stops. You also want to not trade too large, because if you trade too large and you use too much leverage, there's a lot of danger to using too much leverage, because if you use too much leverage, and I think Boris likes to show this chart a lot, and he showed it at the last session, you could blow yourself up very easily. So if you use no leverage and you have 5 consecutive 1% losers, you could easly make it back. You've lost $500 off a 10,000 account. I think most of you can say that you're confident that you can make it back. But if you use 10 to 1 leverage, or you've used too much, put on too large a position, you've basically drawn down with 5 consecutive 1% losers, and sometimes we all hit that losing streak. You've drawn down 50% of your account, and at that point, it will be very difficult to come back to even. Because if you lost 50% of your account, you have to make back 100% in order to get back to even. And in order to make back 100%, you're probably trading a lot more recklessly than you normally would be. And the third mistake is despair in the face of failure. Because sometimes you may have a series of losing trades, and you may think, is this a losing strategy? Yeah, it's got 4 losing 50 pip losses. And this is the same scenario. But if you look at it from a long-term perspective, you got to have confidence in your strategy, because if the strategy produces more greens than reds over a long-term period, you can't have despair in the face of failure, because oftentimes when that happens, you start trading recklessly rather than trading your trading strategy. The biggest mistake that traders make is adding to losers, is basically not giving up when the market is telling you that your idea is wrong. Like if you were long euros and you keep on buying and you want to add to the position, you'll just end up having a margin call, because trends, and the most important tip I can leave you with is that trends is your friends when it comes to trading Forex. And it's much better to follow the trend than to fade it, unless you have a good reason or a good level, or one of those picking tops and bottoms setups that tells you that it's stopping. Otherwise, it's just probably just going to continue. So that's it for me. I'd like to open up the floor to questions that you may have now about anything that we talked about.
Hi, Katie. Thanks a lot for the webinar. So I'm gonna start with the first two questions. They're about the Turkish lira. So first question. You know that Erdogan has had a call to action and said to all the Turkish people to, if they hold euros, dollars, or gold, to sell them to buy the Turkish lira. Do you think this will happen? And if yes, how is it going to affect the markets?
Well, if you just kind of put yourself in their shoes, the Turkish lira is collapsing. The economy could be collapsing, whereas you know, the Eurozone economy is in many ways still more stable than Turkey's, and a lot of, you know, the other currencies are still more stable than Turkey. Would you heed his call to convert? Probably not, because, you know, maybe you'll convert a little, but you probably won't convert a lot, because you probably are getting angered by what's happening to the lira and to the economy, and you want to keep some of your funds safe abroad just in case this whole situation worsens.
Perfect, thank you. So next question, it's a correlation between the yen and the Turkish lira that this client of ours is seeing, and he wants to know what you think about it, and if you think that there's been many traders in Japan who are trading interest rates and now are in trouble.
Well, let's look. So I pulled up dollar yen, and we're going to put on the dollar lira chart on top of this. Oh no. Let's see if I can stack it, make it a little bit. Okay. All right, here we go. So the blue line is dollar yen, and the orange line is Turkish lira. And, you know, nothing was going on in Turkish lira at the beginning of the year, so we'll just zoom in. So this is a daily chart, and you can see that there isn't a significant correlation between these two instruments, particularly since during the blow up period, which is probably the best period to look at, this period when it blew up. There isn't a significant amount of correlation, but it's kind of unavoidable in a sense, is what I'm trying to say, because it's very difficult if we have a kind of a risk-off environment caused by, you know, fear of currency contagion for dollar yen to rally, because investors will still want to maybe park themselves, you know, reduce risk, park themselves into safer assets and maybe unwind some of their currency trades. But there isn't too much of a correlation. You know, if I told you there was, I'd be making it up, because you can see from the chart itself there isn't too much. We can even look on a 1 month basis. You can see that when the lira was skyrocketing, dollar yen was falling, and when the lira was falling, dollar yen was rising. So maybe you could say it's an inverse correlation, but that would be stretching it as well.
Okay, perfect, thank you. So next question, it's Kathy. Another inverse correlation to consider is gold and the South African rand, so USD ZAR. Gold is currently at 9 months low and the rand is at 9 months high. What do you think about that?
I'm sorry, what's the first one? I heard the rand. What was the other one?
It's gold.
Oh, gold. Okay, so let's you know, obviously South Africa produces a lot of gold, so there's a logical correlation, a logical reason for the correlation. Yeah, in fact, gold is more important to South Africa than it is to Australia, so it should naturally have a strong correlation. So I inverted the rand because you know, when gold prices rise, it is positive for the rand, and when it falls, it's negative for the rand. So so look at this. This is, let me just go further back, 5 years. You know, very, very strong correlation. between these two instruments where, you know, they pretty much are mirror images of each other. Now let's go back to a year. And you can see the correlation very strong. The orange line is the rand, the white line is gold. So right now, the rand is falling more faster than gold because people think that the gold is going to continue to fall. So what this tells me is, first and foremost, there's no divergence. So it's not like any ARB opportunity that you could trade. Like whereas here in mid-June, there was an ARB opportunity where gold flatlined and the rand was falling. But this suggests to me, first of all, if you're trading gold, gold should continue to fall. If you're trading rands, there's no reason to stop selling rands because it looks like it could continue to move lower. Now, if you're asking me how much further could gold fall, you know, basically, I mean, we're below a lot of significant support levels. So we could get to 1100. In gold, which would be consistent with, you know, for that much more of a decline in rand. Other questions?
Perfect. Okay, another question about the Australian data. It's do you trade?
By the way.
Do you trade? Thanks to the clients. So the Australian data, is it the same? Even do you trade it the same even when it's negative?
Do I trade the Australian dollar the same even when what is negative? Gold or?
Because you remember in that part you said that even if the data is coming out of the banks, it's good data and you actually fade it, and so they want to know if the data is actually negative. Do you use the same criteria or do you use something else?
Oh yeah, absolutely. If the data is negative, you know, it's more likely that's faded than followed, and you know, it's quite I won't say it's a quite easy trade, but it is in a way, right? Because if you faded it and you're picking a bottom, your stop is simply the previous news candle, the 5-minute candle low, which won't be very far away. So if your stop is at the previous news candle's low, you're having a very tight stop trying to pick a bottom. And if it takes out your stop, then it becomes a follow trade. So there's kind of a two-pronged opportunity there. I don't think there was a significant piece of data released that was significantly negative. We can try Australian PMI services on the 2nd at 7:30. Let's see if we can find out what happens there. It's not hugely significant, and so the 2nd. So this is the data release, this candle here. So this was the data release. For some reason, the market thought this was good, and they ran Aussie up. If you weren't looking at the charts, you can see that that you know, basically the initial move, which is the rally, you'd be fading the initial move, and then you see continuation. And it only went like 10 pips lower before it eventually reversed. So maybe you want to give yourself a 20 pip stop or something like that. But what you want to fade is not necessarily the data, but what the market's reaction to the data is. This wasn't much of a move. We'll try to see if we can find one more. If not, I don't want to waste time doing it. Okay, CPI. See if we CPI on the 24th. I don't know if my 5-minute charts go that far back, but we'll try. So basically, you're just fading the 5-minute candle here. So this is obviously the news candle. What happened? It spiked up and it crashed. So in this case, your fade, because it is a big piece of data, your fade, you can either say, oh, okay, you're fading this move, but honestly, this is a really bearish candle. So if your fade, so if you went long, let's say you went long here at 74.22, your stop would have been 74.18. So it's like, really, is that low? Yeah, so it's like less than a 10 pip stop. Okay, so let's say you lost 10 pips. That's fine. It broke the previous low, then it becomes a follow trade with a stop maybe about 50% of this candle and becomes a very nice follow trade. So you can trade it both ways. Questions? Next question.
So we have one last question, and it's in respect to Brexit. What do you think that the cable has already priced in the effects of Brexit, or are we going to see a difference in pricing in the next few months?
Well, you know, cable's gotten crushed. It completely shrugged off the Bank of England's rate hike. So in many ways, all it really cares about is Brexit right now. But if we get the news that, which is a very long time from now, they're not going to really say it right now, but if we get the news or if we get greater indications that there's going to be no deal, you're still going to see pound fall. We could still get down to 120. This was when, you know, we had Brexit being announced. So if there's a no deal Brexit, we could definitely continue to fall in pound dollar because the market hasn't completely priced in no deal Brexit. They're starting to think about it, but you know, they're still hoping that it's going to happen. Or at least, you know, it's not that it's good for the economy if Brexit happens, but at least, you know, it would be a clear path forward rather than just continued uncertainty.
Okay, I think that's all. That's all questions that we have.
He's very successful. Okay, sounds good. So really great questions. I really appreciated that because it really means that you guys are engaged and interested in what I'm talking about. So thank you all for joining me this evening. And I will be back in 2 months.